and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace.
The recent indicators points to the modest growth and spending and productions. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated and reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and the broader price predictions.
What I want to do is put that question of pace in the context of our broader tightening program, if I may, and hit to talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement. Because that really does become the important question we think now is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. This is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up.
Russia's war against the Ukraine is causing the tremendous human and economic hardship. The war and the related events are creating additional upward pressure on the inflation, and we are warning on the global economic activity. The committee is highly attentive to the inflation risk. Hello, welcome back again. In this video, we're going to be talking about Fed interest rate hikes, and Bitcoin is going to drop. So watch the video until the end and don't forget to subscribe the Bitcoin Thinking channels. They are said that price stability is the responsibility of the Federal Reserve and the serves as the bedrock of our economy. Without price stability, the economy does not work for anyone, in particular without prices stability. We will not achieve a sustained period of the strong labor market conditions that benefit all. Today, the fomc raised our policy interest rate by 75 basis points. And we've continued to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will recurring, maintaining and the restrictive stance of the policy for some time. I will have more to say about today's monetary policy actions for brief economic development. The simple question arises that another Fed rate increase could impact Bitcoin prices. Another Fed rate increase could impact the Bitcoin prices. The Federal Reserve is expected to announce another big rate increase Wednesday afternoon with potential to shake up a relatively stable crypto market. Bitcoin and Ethereum price have seen swift drops following a previous Fed rate increase this year, and the drop this week has a potential to erase moderate recent gains to the top two cryptos. Bitcoin recently climbed past $20,000 with Ethereum recently topping the $1,500 for the first time since mid-September. If these early results hold and it ends up being anything like previous Fed meeting, this year's crypto investors could be in for another roller coaster this week. Historic price chart shows how Bitcoin price dropped by at least 10% or more following the Fed meetings in March, May, and June. While the drop following July's meeting was less severe, there was a clear pattern for Fed rate increase corresponding to drops in the crypto market. Bitcoin price briefly declined during the week of March 13, the same week as the Fed's second meeting this year, before climbing back up. The Fed approved 0.25% rate hike, which is the first increase since 2018. The Bitcoin price spiked immediately after the Fed meeting on May 3 and 4, but then began to decline significantly on May 6. The Fed in May approved a half percentage point hike and laid out a plan starting in June that reduced the central bank's $9 trillion balance sheet. Bitcoin price dipped as low as $17,500 following the Fed's two-day meeting on June 14 and 15. The Fed raised interest rates by 0.75% increase. Bitcoin price drop following the July meeting was a bit smaller at around 5%, following by a quicker recovery than the previous Fed meeting. Aggressive rate hikes are not positive for the crypto prices, and experts say the cheapness will be likely continued in the short term. Risky assets like stock and the crypto have been heavily correlated since the start of the 2022. Both have been moving in unison and struggle to gain any momentum this year as investors are pulling away in response to the rising interest rates, surging inflation, and a potential recession. If the stock market dips because of the under rate hike, the crypto market will likely to, and vice versa. Bitcoin prices fall after the Fed meeting. Powell is pulling the strings. The resumptions of the sideways trending for the Bitcoin on the daily chart is not too bearish yet, according to Kitco's senior technical analyst Jim Wakeoff, and noted that a flagging prices uptrend is still in the place on the daily bar chart. Bulls still have the overall near-term technical advantage, but not to be a show fresh power soon to keep up. The largest cryptocurrency by market capitalizations ticked down, but only slightly, forming a fourth consecutive 75 basis points increases. The largest cryptocurrency by market value was recently trading at roughly $20,000, down 1.3% over the past 24 hours after rising earlier in the day. As CoinDesk analyst Glenn Williams wrote early in the day, the crypto winter has given bullish investors the opportunity to accumulate at a favorite cost basis. Larger crypto investors are continuing to explore this opportunity. Is Bitcoin market entering a new phase in potential accumulation season? Bitcoin and Ethereum significantly declined in recent months, is providing bullish investors the opportunity to accumulate at a favorable cost basis. Large crypto investors are continuing to explore this opportunity. Bitcoin has been trading in a narrow range for nearly 5 months, with spot at about $19,000 and a good portions of the time. Ethereum has dipped as low as $1,000 but has mostly hovered around $1,300 over the same period. Now both have stepped up a rung and with the spot above $20,000 and $1,500 respectively. The US Central Bank raised the main interest rate by 0.75%. As expected, officials says they shall monitor lags on the impact of the collective effort so far, possibly a tip that dovish shifting is being considered. The US Federal Reserve on Wednesday raised interest rates 75 basis points to range of 3.75% to 4%, a move that was widely anticipated by the market participants, including Bitcoin traders. It's the fourth consecutive rate hike of the magnitude by the Fed, which has aggressively been moving to jack up borrowing costs to cool the economy and in run-up bring down the highest inflation rate in the 4 decades. Consumer prices have been rising at a pace of the 8% on the 12-month basis, more than 4 times the Fed targets. Ongoing increases in the target range will be appropriate in order to attain a stance of the monetary policy that is sufficiently restrictive to the return inflation to 2% over time, according to a statement from the Fed's monetary policy panel known as the Federal Open Market Committee. That's it for today. If you haven't subscribed the channel, turning on the red notification button, and see you next time.